Nice.
All right, so like always, welcome everybody. Welcome, Mark. Disclaimer, today's Saturday session is for educational purposes only and merely ideas given by me, ideas given by Mark, and whoever else is going to talk. Nothing stated during the Zoom session should be taken as an indication to buy or sell. Nothing stated in the Zoom session should be seen as investment advice. If investment advice is needed, I ask that you please contact the registered financial advisor or fiduciary. Like I like to say, financial advice, financial advisor. All right, so with that being said, the floor is yours, Mark. I know the people got questions. What questions do y'all have? There's no guidelines to this. Like last time, if you have a question, please speak up and ask away. Unmute yourself. You have been unmuted.
We're hearing this in echo. I guess to just give a quick overview, because I like to kind of like just overviews of what we've kind of like experienced over a period of time. Oh,
I'm getting ready to mute everybody, Mark, and then can you just unmute yourself?
Sure. Okay. So pretty much here's the current landscape, shall we? Because I always believe that if we understand where we are, then essentially it's easier to understand where we're going. So here's the current landscape of what we see, not only just in the United States economy, but let's look at things globally. We see that China is definitely on a significant economic rebound. I mean, of course, take it with a grain of salt because of the fact that, you know, there could be a few stretches of a little bit of the truth in some of their data, but that's okay. We see that there's places that are starting to go into lockdown or starting to go more stringent when it comes to COVID-19. One of the biggest things that I've been looking at is supply chain and logistics over the past month to see how those things are impacted. One of the things that really has me paying attention, that gave me a little bit of pause for nervousness, but not too heavy when I think about it in the long term grand scheme of things, is definitely how supply chains have been impacted. So for example, you know, though that on one side we say that NVIDIA had a successful launch where as soon as the products came out, they sold out in 10 minutes globally. But then that also says that there's an issue there because of the fact that they weren't able to produce that much. And so that their supply chains were significantly impacted. And I think that that could have a negative impact on their earnings. When I look at also other things, like, for example, I think coming up next month, we'll be seeing that Sony and Microsoft will be releasing their gaming consoles. And I think that their pre-orders have already sold out. So they've already mentioned that they're going to be coming in limited supply. I'm kind of wondering what's going to be the same fate for, is AMD going to be suffering that same fate? Though that they typically do well when they come to ramping up quantity for their launches. Also looking at Apple, I think they sold out in Taiwan I think they sold out at 2 million iPhones at release. I'm waiting for the Pro Max, so, you know, large hands. But it's really making me, like I said, it's making me a little bit nervous because of the fact that, you know, with supply chains being kind of impacted thanks to COVID-19 and the temporary, I think that we could be seeing some of that impact come forth when it comes time for earnings. But keep in mind, I think for anybody that saw the June 23rd episode of what I did on the Come Up series, I talked about, like, don't be surprised when you see during earnings, during the early part for Q2/Q3, you see that a lot of companies will sandbag their earnings guidance. And so what I mean by sandbagging their earnings guidance, that means that they're going to say that, okay, hey, we're going to pretty much under deliver. And then essentially Q4, they come out and just blow it out of the park. So don't be surprised there. I mean, it typically happens year over year. I think that this year is actually going to be probably the one time in, in a very long time, where we see that the reason why they're actually coming in low and some of their guidance is because of the fact that the data actually supports it. So they're kind of trying to weather expectations. I think that also, since we came off of this magnificent rally during really the spring and summer, we're seeing that a lot of the Wall Street expectations are still high. And at the same time, companies are beating in their earnings. It's just that Wall Street analysts had their estimates set ridiculously high. And honestly, a lot of these companies couldn't meet it. And then for the companies that did meet the expectations and also beat on their earnings, we're seeing that there's a little bit of underperformance there. And I think that that's also tied to what we see over the next, I think, what are we, like 12, 13 days away from the election. I think that that's also in the sense that you're seeing a significant consolidation in volatility, though that you will see volatility come forth on election day. It will probably be quite aggressive, where you'll have your short sellers or people just trying to time the market and play it just for, either a blue wave or, whatever the stances are. And if you want me to go further into that, just let me know. Because I can kind of like lay out what I've kind of like designed as scenarios for, what happens in any scenario, what happens to the market. Also looking forward is I'm also looking at unemployment. Unemployment is definitely going to have a huge impact, especially if there is no stimulus deal that comes forth until after the election. That can make a grave mistake, especially when we see central banks from around the world are saying that you need stimulus now. It needs to happen. So I think that without stimulus, the market could be headed for somewhat of a little bit more of a prolonged dark turn. But in the grand scheme of things, I think that still the fundamentals will always win out, and people will always come back in to buy. I think that also the reason why I say that I'm really heavily looking at unemployment is because I'm also looking at some of the data of what they're saying about people's savings and how they're starting to become a lot more depleted in specific areas. And so with the depletion of their savings, means that essentially if their savings start to become depleted, then they will have to start pulling from other sources, and those sources could be from the market. So just kind of looking at that, and that's what I've been kind of like toying around with as it pertains to data. My general outlook for those things, though they may sound like I'm looking at this data and it sounds very, very grim, that's just me of just telling you of what I've seen as the landscape of what it currently looks like, but doesn't mean that that's what it's going to be a few months from now. I do believe that supply chains will definitely get better because they have to and they want to. I definitely believe that we will come forth with some form of a stimulus package or stimulus deal. I do think that it will be not on time or ahead of schedule, because that's already over and done with. We're past that point. We're kind of like in the end game now, where it's just like something's got to happen. And if it doesn't happen, then like I said, we could be seeing a little bit of risk off go into the market. The markets are already pricing in the election for possibly Joe Biden taking the White House, as well as the market's starting to price in potential Democratic blue wave sweep. And I guess I'll leave it there just to let you know what the playing field looks like. Now, of course, feel free to ask me any questions that you may have.
Hey, Mark.
Hey.
First and foremost, thank you for what you do for the community. I'm part of the Come Up Cousins, so shout out to the cousins that's on here. So with all the things that you're talking about in terms of looking at supply chain, looking at just the way you're seeing it, how should we as the retail investors be looking at some of this stuff to kind of either hedge the positions that we currently have, or if we're not in yet, to think about, okay, how can we strategically start planning ahead so we don't get clapped by these things
Well, I mean, if
are
people
taking
are
place?
following my strategy of what I kind of like laid out, I said that, you know, pretty much you should be focused on long term. I think that 2021 will definitely look a lot different than 2020. I think that a lot of investors are lining up for that. I mean, institutional money is still not even in the market. So what you're seeing is a market that's heavily induced by trading quants, or AKA trading algorithms, and more so retail investors that are taking place. You haven't even seen institutional fund managers really start to step into the market. Now, will they? I think that they will. But they're slowly nibbling onto things. As we look at retail investors, so pretty much each and every single one of you, as well as myself, what I've been doing is on dips, I'm buying. I'm buying long-term positions, and I'm just increasing my positions so much that for the first time ever, I'm actually shaving off from the 20% of stocks that I own and that I've held for a very long time. I'm shaving from there and looking into furthering into options plays for the long-term 2023s. And I probably will deploy more capital into the market when it comes time around December. If you want to, like, for example, if you want to hedge yourself for election day or for election week, you can do that. There's nothing wrong with playing some puts there to protect yourself as a safeguard. I would just say, don't try to hold your puts and try to be greedy with puts when you see that you have essentially when you made a significant portion of profit, nothing major though, just leave. Just sell. Don't try to be don't try to hold on for dear life and say, hey, I can get more and more out of this. Essentially just take it, so that way essentially you pretty much made the capital on the hedge side, and then essentially you can use the capital from the hedge side just to move into something else. The beautiful thing about rolling a put is you can roll a put into a call position. So you can actually make that transition fairly seamless. I would say if you don't want to do the hedging route, then if you're already in, like I said, if you're already in long-term strategies, just stay put. If you're not in anything, then it's just gonna produce an even more better buying opportunity for you. Just make sure that, like I said, be sure to look at the differentiation between a damaged stock versus a damaged company.
So if we're not in now, is your suggestion to still look for a ideal dip, or just to wait until December?
I would just say wait for an ideal dip, because, like I always said, trying to time the market perfectly is never really a perfect science. It's never. I'm honestly, in my years of trading, I've never been perfect at it. The biggest thing that I've always just said is just, as long as, especially when you're doing long term, honestly, you're looking at it as in the sense of getting the best price that you possibly can. But then there comes this point where you're just saying, okay, hey, this is just too good that I got to step in. So I did that also after I saw that Tesla went negative after a solid earnings beat. I actually increased that position by 7%. And then on top of that, what I did was I took the proceeds from Snap after I had a call going into next year's June. I took that call, the profits from that call, and then I pulled out, and then I said, well, I actually just rolled it into a put now. Let's see, if you're not in the market, like I said, wait for a day of a dip. I always say wait for a clearance sale day, which the market will be giving you those. And then just pick your spots just to get in. And if you want to, you can technically average. You can kind of like dollar cost average your options plays if you want to. There's nothing wrong with that. But like I said, when you're focused on the long term, what you pay today is like, once you bought it, it's like, for me personally, I don't really care anymore after what the price that I paid that I bought it for, because from there, I know what the trajectory of what the stock is going to do. So for me, it's just a matter of time and where the bid price will be of where I will be able to sell at later on. Hopefully that answers your question.
Yes, thank you.
Yep.
Marcus Kells, hello.
Hey.
Hello. I'm at work, so excuse me. But since we know you got into 2023 that first week, can you Are you still in the red on those calls? Because we know that they were super expensive, and we
On the
know
what
that we've
positions?
seen from the 2023s,
Some of my
XLY,
2023s I'm negative on, and then the other ones I'm not. Like, for example, my SMH 182 call, I'm actually still very positive on that one. I think I'm up 30-40% on those. And then what I also did is on days of the dip, I've also been looking into the 2023 $200 strike as well. So it's just allowed me to, you know, pretty much add on to my positioning. Some of my positions like the XOK, I think the 130 call, I think I'm down by probably about 16%. I think on my ARC, I think I'm down. Actually, I'm not significantly down. I think I'm probably like 5% down because it was at $100 strike for the 2023. Let's see, probably the one that's probably hurting me the most is probably like my Amazon call. But
okay, because I know the group recently discussed selling their positions because they've been in the red this whole entire time, and then getting back in. And I know you always stay the course. I get it. But I know a lot of people don't like to see that red. And so I just want that to be a reminder that, you know, you showed us a chart where you zoomed in and you zoomed out and you're like, look at the dips.
Yep.
Up close, it looks crazy. But if you look at the bigger picture, you know, it's just a minor little dip.
I always tell people, go back and look at a 1 month and then look at a 1 year. That's the easiest way to do it. I mean, if you really think about it over a course period of time, you're probably down by maybe, you know, September and October, kind of like terrible months. And let's just say that November could be as well. So you just gone through a bad quarter. But still, you have to take into consideration if you're in a 2023, you know, 3 months worth of bad performance will easily be overshadowed by a year and a half worth of long-term trajectory and growth. It will always win out. So, I mean, for those in whom which that want to do that, I can't tell you to essentially, you know, stay. I mean, that's your decision. It's your investment, your choice. I can only just tell you what I do. And there's been moments in which that I've been in a position where I came down all the way to 50%, 60%, but then still came out a year and a half later, you know, my position was still up 500, 600%. So again, I always say for me, what keeps me grounded and humbled is never let temporary moments detract you from the long-term trajectory and growth.
And then my last question, because I don't know how long I'm gonna be able to stay on, is what's your next wild card? Because you told us the wild card after it ran up. So yeah, I'm gonna sit here and ask you, what is your next wild card?
So I'm betting very big into AMD. Very big. So, and then I'm also looking at, a lot of folks haven't been paying attention, but I have been talking about a company called Zscaler. Ticker is ZS. I've been paying attention very heavily there.
And that's a cloud business, right?
It's a cloud business. Let's see. What else? I was looking at Lamb Research, but then when I look at AMD, I like it better. But I'm also looking at Apple because I think that what's coming down the pipeline over these next 3 years is going to be huge for Apple. Also, possibly, I'm actually going to stamp my reputation on it. I'm actually going to say that over the next 3 years, we're going to see Apple release a product that will be game changing. And people already know how I feel about Tesla. So, I mean, anybody who's seen the video that I think I had posted about full self-driving beta coming out, that's huge.
So what's your thought, Mark, on the China issue with the Tesla cars?
I mean, you're going to see these things happen, especially when you've opened up a new manufacturing plant. I mean, you're going to have to work out some of those bugs and some of those kinks. I remember back when the Model 3 came out, when it first came out, there were some quality control issues that took place. But in my opinion, I think that, you know, Tesla, if anything, they've shown us that they can resolve these things. They caught it fairly early, so that way there was no issues on the road. They saw the defect, or they saw that there was an issue. And now they're working to resolve that. Investors like that when you get ahead of the problem versus essentially there's a problem and now you have to be reactionary. So I think that kind of like I think that those issues are like the growing pains, and they will be resolved, and that's only going to make it even stronger. Unlike the GMCs of the world with the Hummer EV. But I guess we'll get to that later.
Hey, Mark, you said you mentioned you can go a little deeper on the election and what'll happen if Biden wins or Trump wins.
Yes.
Did you do that?
You want me to do that?
Yes.
Okay, so let's play out. I always like to look into scenarios. So Trump wins. You probably see somewhat of a market rally, but if Trump wins and loses the Senate, and as well as like the Democrats maintain the House, you can probably see the market kind of trade flat, maybe a little bit up to the upside, but for the most part, essentially, you're probably going to see the market trade flat. If Biden takes the House and the Democrats take if Biden takes the presidency and the Democrats take the Senate and the House is maintained, so overall a blue wave sweep, you will probably see the market dip in the short term. You will see the market dip about 3 to 6%, probably over a period of time. Probably the market will trade in correction territory overall. And then on top of that, like, you know, tech companies will probably lead the market a little bit lower for the short term. If we see Biden take the presidency, but yet the Democrats and the Republicans kind of like are split in the Senate, then again, you may see probably the market trade a little bit flat in the short term, and then essentially rally next year. A lot of the stuff that I'm telling you is just in the short term, just as a heads up, very, very short term. So just market reaction. If Donald Trump maintains the White House and Republicans maintain the Senate, then essentially you will see the market significantly rally in the short term. And then essentially we're going to need to have some type of stimulus in order to maintain the market. And that's the big question. Will that happen? Let's see. Biden takes the presidency, Republicans maintain the Senate, then essentially you will probably see somewhat of a wash because of the fact that it's producing some issues as it pertains to what type of legislation will he be able to pass. The reason why I don't really worry about, like, again, the short term, and here's the reason why. These are like this is definitely like for the election is like kind of like a short or a day trader's dream / nightmare. It's a dream / nightmare, because if you're on the right side of it, then okay, great, congratulations, you won big. But then if you were on a different side of the table, then essentially, I mean, let's just say that you're going to need to you probably may need to take some Advil because you're going to have the worst headache of your life. But when I think about it though, go back and look at the markets and their performance over the period of time during terms of presidencies. If we go back and look at Barack Obama's presidency over his first term, the market was up 72%, and that was coming out of financial crisis. When we look at it over the second term, then it was up 78%. So overall, the market went up 150% over his term of presidency, like during his 8 years. So let that sink into play. So I guess the thing to look at is you can look at any chart in the market, and it will let you know that the market will react, but yet when you look at it in the grand scheme of things, even in a 2-year format, you'll see that the market pretty much doesn't practically care. The things that you see as significant dips are the things that actually hurt the economy or hurt global economies significantly. So when we look at COVID-19, that hurt the global economy, which, as you can see it in the market. When we look at, say, for example, the trade war, that's a global economic threat in 2018. When we looked at potential global recessions on the rise, that was something in which that you can see when you go back and look at the charts. It actually tells you, and it gives you pinpoint data in which you can see that, okay, hey, that this is why we saw the dips. When we go back and look at presidencies, they're like blips on the screen where it's just like, okay, hey, you can easily miss it. You literally have to literally zoom into that time and say, okay, hey, this is where the market was. But then when you zoom out over a 1 to 2 year span, it disappears. Same thing can also be said about corrections, just as a heads up.
Can y'all hear me?
Yeah.
Yep.
So I had a few questions about rolling fours at one point in time. I know you did your videos.
I also have a surprise for you today, and just for you, by the way.
Okay.
I hinted something on Instagram, so today I get to share a nice little tidbit.
Hey, somebody go check his Instagram.
Huh? Remember on my stories where I said that the rolling fours only represented 25% of the equation?
I know.
Yes, and we went crazy.
Yes.
We went crazy in the group chat.
For you, Ty, since you brought me on today, and I know that you're gonna be gone, I wanted to do this as a favor to you, and to put it into this session where I introduced to you another 25% of the equation.
Don't start crying, Ty.
We all might start crying.
Mark, you broke the internet when you posted that. You know that, right?
I did not. I think Antonio Brown is breaking the internet right now by joining the Tampa Bay Bucks.
Oh, yeah.
But yeah, so I wanted to do something special for you, brother. And just as a sign of my appreciation, just wanted to share because of the fact that, honestly, thank you for rocking with me. So today, I have no problem in explaining the rolling fours and answering your questions that you may have, but it's going to be interesting because we may have to stop this recording and pause the recording just for the sake of this, but because I want to hold on to it so that way I can, prepare myself to do it as an actual episode in full length and detail, but something special to you since you probably may not be able to see it in time. I wanted to give it to you so that way you'll know what it is before you even leave.
You want me to pause the video now?
Unless you want me to answer your rolling force questions first.
So my question honestly was, how do you know? Well, I guess people were asking, they said, okay, so you get in Q1, you get in Q2, you get in Q3, you get in Q4. They were asking me, how do you know when to get out? And then when to actually roll over to the next one? Are you waiting for the 500%? Are you waiting for the 750%? So the actual structure of that. So if I start January and I get in Q1, am I rolling that over the following January?
If it's a 2 year position, then you're going to be rolling it over in, I think, June.
Okay. Okay, so each one will roll
you're out that June.
Right. Okay, so I was just making sure because I know people were asking that question and they was like, but when do I get out? Do I get out here? Do I get out there? Do I get out when it's automatically at 500% or
so
700%?
It's never a specific science. It's never a specific science, but essentially what you do have is you have from January to June to essentially get out.
Gotcha.
So
okay.
I typically say the best way that you can be prepared for something, because your positions are going to be your positions. I mean, you can just really just look at the price target unless some cataclysmic thing happens within a company or within an economic sector. 9 times out of 10, nothing's going to slow the trajectory of a stock or a company. So looking at that, you typically, I always say when you start your rolling fours position, that literally tells you that that's your first thesis, and then you'll do another one. So pretty much what I do every end of the year, just as a heads up for anybody that wants to get a little bit into my mind, At the end of every year, the last week of December, I'm literally going through and I'm looking at what do I want to be invested in over the next 12 months? What am I plotting as going to be the winners of the next 12 months? Who's in position to win over the next 12 months? So then go ahead.
So I heard you said that in another video.
I did.
And I watched it and I was wondering, like, how do you decide? Are you going sector by sector to look at companies for the next 12 months?
First, I look at sectors and I see what's winning, and then I see essentially what sector can win out over the next year. So that's the first thing that I do. Then from that deductive reasoning, certain sectors are just automatically going to fall off they're going to fall off the shelf. So then the remaining sectors that are still on the shelf, now I'm looking at, okay, since that's going to be very narrowed down, I'm going to say, okay, hey, like for example, I know that financials will not be a winner next year because the Fed has already said so that they're going to keep rates at zero or as close as they can to zero till 2022 or 2023. So that's off the table. And anything that essentially is predicated on relying on financials, then I can immediately wipe them off the table as well. So then when I also look at, say, for example, the things in which that aren't really predicated heavily on financials. Hey, Patrick, I literally say, okay, hey, what is the catalyst for those things to be successful over the next 12 months? Or say, for example, the next 2 years? What are the things in which that I'm expecting that are going to be releases? What am I expecting as it pertains to things in which that are going to be game changers for them? But then I also have to look at what are the potential potholes ahead. You know, given that we're going into since we're in an election year, how can legislation also, say, for example, be an encouragement or also a hindrance? So I look at economic factors, I look at the company's factors, I also look at essentially the market in the sense of, is the market ready for this? Because sometimes you can release an amazing thing or provide an amazing service or amazing product to the market that the market just isn't ready to actually have. Like, for example, if we're in a global recession and yet we're still we're releasing cars out there that cost almost 100 grand, nobody can afford it. Nobody can afford the vehicle. So that poses a problem. So I do that first. And then after that, now it's like, now that I have like pretty much exactly who I believe that the winners are going to be, now I start going into my analysis of looking at potential price. And what will those price targets look like for the stock based upon previous performance, and then also what potential performance could be. Now, of course, I like to be conservative. For anybody that knows me, I typically like to say, okay, hey, you may have scored 60% this year, but I'm going to still scale you back to about 25 to 30%. And then I'm also going to price in a correction because corrections happen every 16 to 12 months or 12 to 16 months. So I take that off the table. So then after I've done all that, right, now it comes time for me to picking who do I go for first. Now, I think I also did this in the previous episode. See, this is where I always say gems within gems within gems. I also did an episode where I also showed folks, I just gave everybody a quick glimpse of seasonality factor, of what companies do well during specific seasons. For example, Apple is expected to start doing well during this time of the year. Apple doesn't really do well towards the beginning / middle of the year. It gets a little quiet. So I start looking at those types of things and saying, okay, hey, where can the companies or even the index sector, where do I expect it to perform at its peak performance? So like, for example, in XLY, I expect XLY to perform well during the spring and then also come well during the holiday season. That's 2 times a year in which I expect it to be great. So then it's like, now that I have those perspectives, and when I'm playing a position now, right, when I set it up for a rolling force position, I kind of already have an idea based upon seasonality factor, based upon where I'm at as it pertains to price target. And then on top of that, by that time, it's already given me enough time to start looking at what my next position is that I can go into after I leave this one. I always say you have about a year to a year and a half to literally start planning your exit, to look for the next thing. Hopefully I didn't like lose anybody in the sauce of that part of the conversation, because I know I just said a lot.
I have a
No,
question.
I was like, wow. Okay.
I was like, write faster, write faster.
Yeah, right. I was like, okay, well, how long did it take you to formulate this? Like, is this something that you, because I know you started trading in college. So is this just a craft that you've like, or but a formula that you've put together over the course of the years, or did you like read something and something?
Good question. So essentially, like I said, and I think I said it on the Instagram live, I didn't have anybody around to help me when I got to college. Like I literally had to figure it out on my own. So essentially I just, when you lose, when you do a losing trade, that's when it's like, it makes you a better trader. You technically don't become a great trader when you win. You know, I always tell people that you're not a good trader just because you win. You're a great trader when you lose, and then essentially you can learn from it and then essentially figure out how it's that you can do better. So for me, it's like over time, I started taking into account my fundamental analysis, and then taking in my technical analysis of my yearning at the time when I was young to want to being a day trader, and just realizing that honestly, I don't have the time for that. So then I just started to merge those two together. And then it's like taking into account what my grandfather, the first lesson that my grandfather ever taught me before I even learned about a stock chart or anything like that, he taught me 4 key principles. He taught me value, he taught me time, he taught me cost, he taught me worth. Those are the 4 elemental lessons those are the first 4 lessons that my grandfather ever taught me. So if you think about it, from everything that I just mentioned are built upon those 4 key principles that I just literally built on. I said, okay, hey, this is my base. And now I build upon those with my fundamental analysis and my technical analysis, and also just with a splash of common sense.
Mark, quick question on
Thank you.
XLY, right?
Yep.
So I know I think 1 or 2 episodes ago, you and Jolyn had a discussion about XLY, whether it's, we know it's a given, but there was a side discussion about if it's really a strong pick as it was in the past. And my ears were like, I'm listening to this. And I just wanted to see if you could talk about that a little more, because that's like the next heavy hitter that I'm going for in December.
Good pick.
At the moment.
Very good pick. So I look at XLY in the same breath that I look at XLK. Now, of course, a lot of folks can say, well, Mark, that's a little unfair because of the fact that Amazon kind of dominates the entire position. But that's a little bit unfair also because there's some solid, great companies in XLY that do very, very well. And to think like on days when Amazon is negative, and yet you still see XLY up $1 per share or $1.50 per share, and Amazon's down 1%. That's signs of a solid position. The reason why I put it in the same breath of an XLK is because of the fact that when Microsoft and Apple are just struggling that day, then the whole ETF just goes down. XLY kind of trades a lot differently than that. Now, the only thing is XLY has its moments of slowdown because some of the companies that are in there are not as sexy as, say, for example, the companies that are in the XLK sector. So I look at it like this. Here's how I would do a breakdown. Whenever you want to get something, whenever you wanted to get something, it's like your parent, it's like you went to go ask your father would say, go ask your mom. Or if you went to go ask your mom, she'd say, go ask your father. Well, I look at XLY as kind of like that secondary go-to parent, not the step parent.
Okay, I got it.
But I think that they're solid.
What you said before is interesting about seasonality, right? So for XLY, you said that spring and holiday season is when it really moves, right? So then this should then, in theory, inform when you purchase as well, right? So if I were to go in December, I'm really looking at a good move, one spring, one holiday, and one spring to get out in a year and a half, right?
Yeah.
The follow-up question is it a bigger move in holidays? So should I time it out to get one holiday, one spring, one holiday in terms of when I buy?
I mean, either one works. I mean, because
Yeah.
here's the reason why. When you do holiday, you kind of like lose the flavor of, say, for example, the McDonald's, which performs well during the spring and the summer. We also lose, like, for example, your Home Depot and your Lowe's, which perform well also during the spring and during the summer. When you give that up for, say, for example, your Starbucks, which comes out with a pumpkin spice, which the stock always spikes when they announce the pumpkin spice latte, which, I mean, for those, I don't drink coffee, so I don't understand the whole allure. But at the same token, you also have Starbucks, you have, say, for example, your Amazons, which perform well during the holiday season. And a lot of folks are banking it on like Amazon because of the fact that when does Amazon perform well? Well, Amazon starts to become stronger towards the end of the year. The earlier players in the game, though, they're in Amazon long before everybody else is even there.
Got it. Yeah, that's true. And it feels like now we see a lot of things in hindsight. So now, like where we are in the year, I'm like, oh, I should have thought about Zoom because, you know, everybody and their mother, they're using Zoom. So I guess my last question is, how do you get a good feel on what's currently popular without just looking around and looking at consumption? Is there any publications that you're looking at in order to be able to look at popular
secrets today? Okay.
I know, Mark.
Well, here's a secret for
one,
everybody. Here's a secret for everybody. Apple News is my best friend. Apple News is my best friend. So if you have an iPhone, then Apple News is your best friend. If you have Google Android. Hold on. If you have Google Android, you also have Google News. A lot of folks don't know about that app, but Google News is actually pretty legit. So I would say the publications I love to read outside of like the financial markets ones. If I'm looking at anything tech, and if I want to get a good idea of what's happening in the tech space, I look at TechCrunch, VentureBeat, The Verge, I mean, and a few others. If you want to watch YouTube, if you want to really geek out with me, then go watch it. Go check out the channel Gamers Nexus, because he talks about semiconductor chips all the time, and he gives it purely from a technophile standpoint. There's also Linus Tech Tips and my guy MKBHD as well. Huge. Let's see, if you want to look into more so consumer discretionary, I mean, that's going to be a little bit more tougher, but that's where your Apple News is going to hit into the play, where it's like, I would just say or your news apps, just take the top 5 companies that are in the sector, or 10, but I would just say top 5, and essentially just let that be in your following list. And then any news that comes out within those areas, you'll actually be able to find those. And Apple News does a very good job of also being able to provide you with related news. So to say, for example, that article, so you can also get a good look at what the space looks like. I mean, the other way that you can do it is definitely use Zacks as your friend, because their analyst research reports are top notch. They even go even more in depth to tell you why you should invest and why you should not invest. And then from there, it gives you a good barometer to say, okay, hey, I'm going to research every single point just to see, okay, hey, what are they talking about? And it's a very easy read. They don't try to put any of the data that's over. They don't try to provide any significant like terminology that's over your head. They actually try to just give it to you very simplistic. So I love that site.
Okay, perfect. Thanks, Mark. I'm going to jump on for sure The Verge, TechCrunch, and VentureV right away.
Yeah.
Thank you.
Yep.
Okay, so Mark, I have a question. I got into XLY and XLK back when it was really cheap.
Okay.
So when you said to do the rolling fours, I got kind of offended when I looked at the prices, because I got an XLK like at 341, and then it was still going down from there on dip days. So since I didn't buy those two for the rolling fours, and now I want to get in them, do I take my 2022 calls and roll them over? Because I got a nice profit going on now. And so I don't want to lose that.
Two things. One, scared money don't make money. So don't be scared. You'll be fine. The only thing that you're doing is you just bought yourself a whole nother year. So that's pretty dope. I think that also the reason why we've seen the price premium was because of the fact that options market is starting to heat up a little bit and the volatility is still high. I think that it could be a brilliant time because as the volatility comes down, but as those stocks also start to rebound, that also will raise the price of those contracts. You could roll your position.
2022s or wait, 2023s?
Say that again.
Of the 2022s that I have, or raise the price of the 2023s?
It'll raise them all.
Okay.
I mean, volatility is kind of like the dust that touches us all. You don't know it's there until you shine a light and it's there.
So I guess what I'm asking is, do I leave those as is and just buy into 2023 separately?
Both of those are good. Both are good plays. So I mean, it depends upon what your comfort zone is. I mean, essentially, if you want to take the profit off of the table and essentially just continue to try to invest with the principal, or essentially say, okay, hey, I'm going to just stay put in my 2022s and then essentially create kind of like a inverted rolling forwards position because you technically did it before the quarter. And remember, you don't always have to wait for the quarter. I just set that as like a calendar because it's easier. You can set whatever your timeline is as long as it's within a 3-month span. So if you start in December, 3 months from December will be what? December, so January, February, March. But that's pretty much on the same timeline as quadruple witching. You could start, say, for example, January, miss the quadruple witching, come in after all the activity has taken place, and then literally come in around, say, for example, April. And then so on and so on and so on. So you'll be coming in a month after, say, for example, the quadruple witching period. You still there?
Yeah, I'm here. It's just
I mean,
I hate to see there's no
right or wrong way, because both of those strategies they both work. If you want to hold on to your profit and let your profit continue to do its work for January 2022, then go ahead and do it. If you want
it has to now because now it's taking a dip. So where I was saying,
it's gonna take a stronger dip than 2023 because you're a lot closer in the timeline also.
Right. Okay.
So it's like, remember, like when it comes to trading and investing, you can't always have your cake and ice cream and eat it too. I wish.
Okay. All right. Thank you.
Yeah.
Hey, Mark. With quadruple coming up on December 18th, do you foresee those like the XLK positions, XLY, all the ETFs, do you foresee them opening up some other dates besides the January 2023, or is it going to stay that until like sometime next year?
I don't know. I think that they may be opening up contracts in between because there's a large gap of time in between
2022. Yep.
Yeah.
Yep.
So I think that that's what probably may be happening. Because that would be crazy if that's a June or say, for example, September, 2023 call. That's just what? I think that what you're going to see is there's a lot of contracts that are some may just go untouched. Like, for example, we saw during last quadruple witching period, some contracts never even did anything when it came to movement. Sorry, my wife just texted me. All right, so some of these will have like no movement when it comes to opening up contracts, but I mean the ones in which that we kind of wanted to open up contracts could possibly see a January 2023, aka like the ARCWs of the world. Just saying, Cloud. hero.
Okay.
Whisper of a dream.
Thank you.
Hey, Mark. I have a question. You spoke. Can you hear me?
Yeah, I was just looking for you because it's like this mosaic board, so I'm trying to find out where.
You spoke about supply chain earlier, so I'm not quite sure. Again, I'm in Virginia, and some of the things that I saw as far as supply chain shortages were shortages of meats, toilet paper, shortages of medical supplies, and things of that nature. And so, do you think the shortages were just a fluke based on COVID, or do you think they may have some long-term effects that may make us think about the outsourcing that we do to China? So make us look more inward thinking to say, hey, we need to bring some of this stuff back over to the US and start producing it. And then also on the flip side of that, as far as the grocery is concerned, I'm in farmland. And so we see that a lot of people are going to farms now to buy produce and things like that. So I'm just wondering, just in a general question, how do you think the supply chain shortages may affect the way that we produce things of this nature, like the examples that we have, and how may some of that affect the market?
Good question. Very good question. So what I see on the agricultural side, you hit it spot on. There's a lot of inward activity that's taking place, and that should happen actually. When we think about it on the manufacturing side though, that's a different story, because if we manufactured more so inward, like, so for example, we did a lot more US manufacturing, then the cost of products would also be way higher. So the reason why we do from outward coming in is because of the fact that the cost of goods is much cheaper. Now, of course, for the company, it's like the cost for them to create, their margins are lower. And then on top of that, it increases their profit margins, which, I mean, rule of thumb in business, if you want to be in business, you got to keep those profit margins up or continuously find ways to increase them. What I think it is a vast portion of this is due to COVID, as well as some recession items. I think that the reason why we see agriculture has taken such a huge hit is because of the fact of trade war issues that we dealt with in China, and that built up a lot of surplus. I don't know if anybody paid attention or was even learning about this back in 2019, like late 2019, where you saw like a lot of cow farms. They were literally just dumping milk. They were literally just dumping milk because of the fact that, you know, honestly, we were building up all this significant surplus and it's not going out anywhere because of the trade war. So a lot of those agricultural farms have been significantly decimated. Now, what happens also when you have a slowdown in economic growth, right? When you are in a recession, you know, though that, say, for example, you know, job growth and everything else slows, what increases? Price. So, for example, things start to become a little bit more inflated. I don't know if anybody's seen that. Like, for example, when you've gone to Costco or anything else like that, when COVID-19 hit, you probably saw a spike in prices of products, especially like toilet tissue, water, milk, all these other great things. I also believe that, I don't know if anybody else has seen it, I've seen it here in Seattle or in Washington State, where also the quality of products have also started to take significant dips as well. And that's partly because when you see supply chain interrupted, especially when you don't have the men or just people power, for a better word, when you don't have the people power there to literally, you know, pretty much keep the process going, then essentially you see quality take dips. And then on top of that, you see inventory significantly impacted. So, yeah. I guess apparently Jolynn's in here, so that's cool too.
Hey, Jolyn.
Jolyn.
Hey, y'all.
Hey, Jolyn.
Hey. How you guys doing?
All right. Welcome.
Look at all this melanin. Y'all look good, okay?
We're still, you know what? We're still seeing a bunch of like non-faces. I'm just seeing a bunch of like names.
Oh, who's hiding in the shadows? Who's lurking?
Jeremiah, Patrick, even
Oh
though
wow,
they
you're really
were
calling
on
out
earlier.
people. Okay.
Hi, Lily.
Hey.
Jeez.
Yeah, let me see these faces. Whoa, there's
Yeah.
how many are on here? Good Lord.
48.
48.
Wow.
48 and counting.
There's
Jolyn,
our
you got that bonnet
Ingrid.
on?
There's Ingrid.
I'm
Say that
showing my
again?
face, but I'm about to like unshow it.
Ebony.
Wait, let me put it on speaker view so I can catch you right when you come on. Hold on. Hey. So good to see you all.
Thanks for joining us.
Moot.
We're gonna do
Hey,
something.
Mark.
We're gonna do something special today, Jolyn, just as a heads up for Ty.
Oh, cool.
So are we gonna hit the are we
like
gonna
special
hit the
stuff.
start recording button?
Not yet.
Okay, okay.
I'm still answering people's questions. So hopefully, did I answer your question, Lori?
Yes, sir. Thank you.
Hi, Ty.
Hey, Mark, this is Sean. I got 2 questions. One to touch upon Lori's
Guidelines. I'm just kidding.
Yeah, with the supply chain, I just wanted to find out about, do you think there'll be an uptick for them to kind of make up for the lost opportunities and stuff? And will that have an uptick in the transportation industry?
Whew, that's a good question. Yes, I think that we will see them make up for the loss. I mean, we've already started to see that. I mean, I guess a good read to look at is the PMI reading that I think that comes out every month, the manufacturing numbers. We're already starting. I mean, these companies are very good when it comes to supply chain and logistics. So, like for example, when we saw that U.S. and China trade war was definitely a issue, we saw that a lot of American companies started to improve their supply chain by going to different supply chain channels, like for example, moving out of China and going to places like Vietnam and India. And that's a place that a lot of folks aren't really paying attention to, which could be a huge major player that could also challenge China is India. When we talk about transportation, are we talking about transportation as it pertains to vehicles? Or are we talking about transportation as it pertains to like planes? Or
Now, I was looking at some of the trucking industry and the CSX for the trains transportation.
So I think that CSX, I think that they will definitely see significant spikes and increases as we start to move out of recession and as COVID-19 numbers start to die down. I think that ultimately, of course, their industries are gonna move a little bit slower because of the fact that they're definitely I would say look at the correlation of when the numbers come out in correlation to those types of industries like Dow Transports and stuff like that, because they will greatly reflect what those new numbers will be. And I think we're on target for seeing a new PMI number that should be coming out soon. Don't quote me on that. That's just me thinking. Let's see. Yeah, as we start to see that COVID-19 starts to subside, and you start to see that essentially people are able to start getting back to some form of normalcy, or economies getting back to some form of normalcy, and those channels open up, great. The trucking industry, I believe that they're getting ready to get hit, in the sense that you have a lot of states that are moving towards this zero emissions legislation. There is a few players that I know of that are definitely going to be eaten significantly from the trucking industry, especially if you think about how many trucks run through California. So, I'm just saying, just based upon the West Coast. Now, if places like the Midwest join in on those, or just United States legislation says let's move towards zero emissions, zero carbon, that's I would be looking at like the next generation of transportation in that when it comes to that market. I'd be looking at, go ahead, Marseille.
Piggybacking off of Lori and Sean's question. So with the election coming, I don't hear either candidate talking much about like the farmland and how much like China has bought up our farmland here. I'm in Michigan, and I know a lot of our Michigan farmers are really worried about, keeping that land within their families, because it's so hard for them to either like maintain the leasing amount, the leasing cost, or even have the option to actually purchase the land that they've been cropping for generations. So I'm really curious as to like how that plays into, again, our supply and demand with our trade war with China.
It plays huge because ultimately the trade. Did anybody read the book Thinking Strategically? Because I don't want to give it up like fully.
We're reading it right now.
Okay. There comes, I won't give up the answer, but then there comes a section that's, I'll just give you a hint. It starts with the letter B, which is a game theory tactic that has ultimately failed as it pertains to the China trade war between Trump and President Xi. I'll say this. China has always been the country that is willing to make the investment. China has always been the country that is willing to essentially buy up things. They like to own things significantly. I mean, not even just as a country, but also individually. They are buying up a ton of real estate here in the United States. And then they're some of the major benefactors when it comes to Airbnbs. So it doesn't strike me as anything different when they look at agriculture. I mean, they probably have invested in, they probably have a footprint in over 60% of Africa. When we put it into perspective. So, yeah, I definitely see that essentially that they became the lending, helping, quote unquote, hand to United States agricultural farmers. I'm not surprised at all. So I think that, how does that play out? I mean, what do you do when you're in, say, for example, a trade negotiation? The only way that can ultimately stop China from investing is if the United States choose to make the investment into the farmers themselves. And obviously we haven't seen that happen. So unless that happens, China will be the country, or many others will possibly step in and follow suit and be the investor into United States agriculture. And then essentially that just gives them more leverage in a deal when it comes to any type of trade deal or trade war. I mean, imagine what that looks like imagine going into a hostile fight with somebody who already has part ownership in what you already have.
Your land.
That's like fighting a rocket launcher with a BB gun.
Thank you.
Yep. I'm looking around and I'm just seeing all of our faces just in like this deep thought.
Sean, did you ask both your questions?
Oh no, I was rudely interrupted by Mark. But I was waiting till she finished. I didn't want to, cut her off. Now I was wondering about, the COVID economy that we're in right now, and just wanted to find out if you see any contrasting changes in the in the business cycle, along with what you stated before for the seasonality factor.
Sorry, repeat that again. I'm sorry. You didn't come through all the way.
The business cycle, since we're in the COVID economy right now, do you see any contrasting changes within that business cycle as it relates to the seasonality factor that you mentioned earlier?
Yes, I definitely see that happening, and I think that we're all seeing that when you look at service-based industries. They were already decimated, and then essentially that's going to play a huge role. But now it's like markets are looking for who's the catalyst and which that can step up to take that place. We don't know yet. Like for example, around this time we would be expecting that the holiday season or as it gets colder, people want to go to places in which that requires inside. So for example, NBA. Sporting events, theaters, that's not happening.
Yeah, Broadway is shut down out here, so
Broadway is very huge during the holiday season. When it gets cold, everybody goes to Broadway. They dress up warm and they typically look a little nicer, and then essentially like they go show out. Restaurants also do well during this time of the year, especially the sit-in restaurants. So think about a lot of those chains, Tom Douglas chains and everything else. Not looking good. When we look at, even stores, stores essentially they need indoor foot traffic. The problem is that people are afraid to go, so they go to other services. The biggest thing that we got to look at is that, especially if you're a small business, like let's put it into perspective. Uber and all these other food delivery services already take a huge cut when it comes to, say, for example, their services that they provide to restaurants. Anybody that has a small business restaurant, you probably understand what I'm getting ready to talk about. For those that don't know, it's about to be an eye opener. So essentially, they're not making enough as it pertains to the larger players. Like they don't get the same type of percentage deals as, say, for example, the McDonald's of the world, all those other fast food chains, the larger ones that are out there. You have you significantly seeing them being undercut. So which means that they're taking the higher cut, but whereas the larger companies are taking the lower cut. And then essentially it's like they're just barely hanging on. So when we look at seasonality factor, that plays a role. Because essentially what you're looking at as it pertains to seasonality is you're looking for profitability. You're looking for where is the best opportunity and where I can invest my dollars. If these sectors are already being hit hard and they're also being cut significantly by the same companies in which that they work with that are supposed to help them bring forth business, and then on top of that, you're not getting as much foot traffic, they're hurt. Like, I wouldn't be surprised if you start seeing other companies stepping in to buy other companies more at a discount. And honestly, seeing other companies going out of business. You're definitely going to see that happen a lot sooner, especially since there's no stimulus. Somebody asked a question about would we be better to look at defensive sectors such as consumer staples, utilities, and healthcare? Utilities, I think, is ultimately a place where people just run from when the market is bad, and then they essentially just run to these sectors. We've seen that, and I'm probably sure that Jolyn could probably attest. We typically see that people run to sectors like consumer staples. I mean, honestly, I don't think that really anybody invests in P&G anymore, or those types of companies. I mean, it doesn't mean that they're bad companies. It's just that honestly, I think that consumer discretionary is now the new consumer staples, and so it's the same thing for tech. People need tech more and consumer discretionary more than they need the consumer staples. And then on top of that, when we look at the profit margins of what consumer staples can provide, they just can't do it. When we look at utilities, I mean, kind of the same thing. I mean, yeah, it's the seasonality factor is there. Like, for example, as things get colder, then you look to natural gas companies because, of course, people need to use that to heat their homes. And then, but at the same token, it's like, can I get the same type of profit margins and the same type of allure of other investors that would love to buy into these plays? I think healthcare is good, but healthcare is also one of those ones that it can't be considered defensive since it's up on the docket right now and it's a political issue. So is it really defensive right now? I would say no. I think that the only thing that's really propping healthcare up is the fact that we're seeing that coronavirus treatments from like your Gilead Sciences and stuff like that. More like your biotech industry is really helping healthcare right now. Yep.
Hey, Mark, Lily, how's it going?
I'm all right. How are you?
I'm good. So last week or the week before, someone asked you about dividends and you made a face. And then they didn't ask you to clarify what that face was. Okay. What are your thoughts on that? On investing?
I I think that if you have large portions of capital and you're able to invest in a significant portion of stocks, then dividends definitely are a great vehicle. I think that for some folks, it's a great vehicle and model to give you some fixed income over. There's monthly dividend plays and then there's quarterly. I think it could be a vehicle in which that can work, but when I look at it in the grand scheme of things, people want to make money. They want to return, significant return. You know, there's some great companies out there that give some solid dividends, but let's look at it into perspective. A yearly dividend of about $2.45, right?
Mm-hmm.
How much stock would you have to own in order to really see the strong benefit of that $2.45 per year dividend?
A lot.
So, you know, for me, it's like I cringe a little bit because of the fact that, you know, if you own 10,000 shares of a company and they pay you $2.45 a share, oh, then kudos to you. Congratulations. But if you only own, like, say, for example, 50 to 100 shares of the stock, I mean, that's what, $245 a year. I mean, technically, just for perspective, you should be seeing that type of return just within the stock alone,
right?
With those shares, right?
Right.
So that's why I cringe a little bit. But, you know, to everybody, like, I'm not gonna be the same. I'm not gonna be that guy that, like, literally, you know, takes a dump on somebody's investment strategy and thesis. I mean, because it may work for them. And I think that Britta, when we had her on the show, she represented that. She represented that example of the fact that she mentioned, hey, you know, these dividends that I have, they literally can pay for a specific bill or sets of bills in which that I can benefit. And that works. For others, it's like, it just depends upon how is it that you want your investments to work and what your financial goals are. I think that that's what it comes down to. When I look at the majority of retail investors, they want returns. They want returns. And then maybe once when they reach a certain threshold or a certain, you know, a certain income, then at that point, then they say, okay, hey, now I can start playing income, dividend income plays.
Makes sense. We want that demon time. So that ain't it.
Well, let's try to get y'all there.
Okay.
Hey, Ty, Robin's trying to get in. Sorry.
How are y'all doing? Is everybody okay?
We're excited to hear about this 25%.
Where's Ty at? Okay, there's Ty. All right, so this is where we turn off the record.
No, wait, Mark, I got one more question. When you invest in your Roth IRA and you fill it up with long-term investments, because I didn't know to trade options out of it to save on taxes for the profits. So in January, I'll be able to throw in another 6,000, but how do I pay myself? I heard you say pay yourself out of your account. How does that work?
You literally just send the money as a deposit to your checking account and take the taxes out, and boom, you just paid yourself.
So it's no tax hit?
You take it'll actually, if you want to take the taxes out long before you even as you're making the withdrawal.
Okay.
And remember that it's taxed differently. So essentially, it's not looked at as active income tax. It's actually looked at as passive income tax. Now, keep in mind, there's some other things in there. You may want to consult with a financial advisor, and hint, not a Series 65 or Series 7 here, but you know a few things. You can feel free to go and validate those later with a third-party source. What you have to also look at is, depending on where you live, state income tax also can play a role, and then also federal.
Mm-hmm.
So, but outside of that, you should be good to go.
Okay. Thank you.
Yeah. Any last questions before we go into, dark mode?
Yep, I do. Sorry, one more question. You said you were bearish on Amazon, but then also said that they perform well in Q4. Are you still bearish on it?
Bearish on Amazon?
You did on Tuesday.
On Tuesday?
Yeah.
I thought I said I was bullish on Amazon because I am bullish on Amazon.
No. You said bearish.
Oh, I may have misspoke. I am definitely very bullish on Amazon. I'm sorry.
Well, no, I know I'm down on Amazon too. So, I mean, what you said made sense, but
Yeah, so I haven't, just as a heads up, I haven't been betting against Amazon. No, I've actually been looking to buying into more contracts of Amazon lately.
okay.
It's like you don't bet against Tom Brady. You don't bet against Amazon or Jeff Bezos.
Okay. I'm done.
Especially now that I can't bet against Tom Brady now that he's got Antonio Brown, which I'm a little salty about, but you know, that's a whole nother day.
All right, so you want me to go ahead and stop it?
All right, let's stop it.